Being debt-free feels responsible, it feels disciplined, it feels mature, it feels like the finish line. No obligations, no lenders, no monthly payments hanging over you. For decades, that has been framed as the ultimate financial milestone. Pay off the house, eliminate the mortgage, destroy the student loans, own everything outright. Freedom. But in the modern economy, that instinct, while emotionally comforting, can be financially expensive. Very expensive, because while you're celebrating zero debt, inflation is quietly eroding purchasing power, asset prices are compounding, leverage is accelerating wealth for those who understand how to use it, and the compounding clock never stops ticking. In some cases, the decision to eliminate all debt, especially low-cost debt, can cost you millions over a lifetime. Not because debt is good, but because blanket rules ignore math and markets don't reward comfort. They reward positioning. Ever wonder why the richest people are almost the most indebted? Part 1. Why we worship being debt-free. The cultural obsession with being debt-free didn't appear randomly. It was shaped by history. The Great Depression, the 1970s inflation crisis, personal bankruptcies, housing crashes. For many households, debt represented vulnerability, so financial advice simplified the message. Debt is dangerous. Eliminate it. Avoid it and sleep better. Emotionally, that advice makes sense. Debt creates anxiety. Obligations feel restrictive. Zero balances feels clean and final, but emotional comfort and financial optimization are not always aligned. There is a difference between destructive debt and productive leverage. Credit card balances at 22% interest and high personal loans are destructive debts, but a fixed-rate mortgage locked in below inflation, that's leverage. And leverage, when structured correctly, amplifies exposure to appreciating assets. The wealthy understand this distinction. Most households do not. They treat all debt as moral failure, while sophisticated investors treat debt as a tool. That difference alone creates divergence over time. Part 2. The opportunity cost nobody talks about. Let's slow this down. Imagine you have a 3% fixed-rate mortgage, and you aggressively pay it down early. Every extra dollar goes toward principal. The emotional return feels high, but what is the financial return? 3%. Before inflation. Now consider inflation averages 3%. That means, in real terms, your debt is shrinking every year. You're effectively repaying it with cheaper dollars over time. Meanwhile, broad equity markets historically compound at significantly higher rates of over 7% annually over long periods. Real estate appreciates, businesses reinvent profits, capital grows. If instead of accelerating debt repayment, you deploy excess capital into productive assets compounding at higher long-term rates, the spread compounds, and compounding is nonlinear. The gap in year 1 looks trivial. The gap in year 5 looks modest. The gap in year 20 becomes dramatic. The gap in year 30 can reach 7 figures. This is the opportunity cost few people calculate. They calculate peace of mind, but they don't calculate foregone compounding. And foregone compounding is invisible until it isn't. Part 3. Inflation changes the equation. In a low-inflation, high-interest environment, aggressive debt elimination can make sense. But in a structurally inflationary system where central banks expand money supply and asset prices trend upward over decades, fixed-rate debt behaves differently. It becomes a shrinking liability. Your payment stays constant while the currency loses value and asset prices rise. Effectively, the real burden declines. Meanwhile, the asset tied to that debt, a home, a business, an investment, may appreciate. This dynamic is why corporations rarely rush to eliminate all debt. It's why governments operate permanently with debt. It's why large investors borrow strategically, because they understand time plus inflation changes the risk-reward equation. Debt under certain conditions becomes leverage, and leverage accelerates asset ownership. Part 4. Why the wealthy don't rush to zero. Observe how high net worth individuals operate. Real estate investors use mortgages to scale portfolios. Private equity funds use leverage to amplify returns. Corporations issue bonds to fund growth rather than draining reserves. They don't seek zero leverage, they seek optimized leverage, because eliminating leverage entirely reduces exposure, and reduced exposure limits compounding. The middle class is often taught that debt equals danger, while the asset-owning class is taught that mismanaged debt equals danger, and strategic leverage equals acceleration. That philosophical difference compounds across decades. Part 5. The real risk isn't debt, it's fragility. Now let's clarify something important. Leverage without discipline destroys wealth. Overextending into volatile assets creates risk. Consumer debt erodes flexibility. But zero debt does not automatically equal strength, and true financial strength is resilience. Resilience means stable cash flow, liquidity reserves, income durability, asset ownership, and optionality. A household with no debt but no appreciating assets is still vulnerable. A household with manageable low-cost leverage and growing assets may be significantly stronger. Debt is not the core risk, fragility is, and fragility comes from imbalance. Part 6. The $1 Million Divergence. Now let's make the title concrete. Imagine two identical households with the same income, same savings rate, and same discipline. Household A aggressively eliminates a 3% mortgage over 10 years. Household B maintains the mortgage and allocates excess capital into productive assets, compounding at higher long-term rates. Over 25 to 30 years, the difference in total net worth can reach 7 figures, not because one gambled, but because one maximized compounding exposure. Small percentage differences, multiplied by time, creates enormous divergence, and time is the only variable you can't recover. Once compounding years are lost, they're lost permanently. Instead of asking, how fast can I eliminate debt, ask better questions like, what is the interest rate? Is it fixed or variable? What is the inflation rate? What is my expected long-term return on alternative investments? How stable is my income? Debt is not moral, it's mathematical. Used carelessly, it destroys, but used strategically, it magnifies. Blanket rules ignore context, and context determines outcomes. Being debt-free feels clean, but cleanliness is not the same as optimization. Safety in the wrong dimension can be expensive. The goal isn't zero debt, it's intelligent positioning, not reckless leverage. Not blind repayment, but strategic allocation in a compounding system. Because in an asset-driven economy, the question isn't, do I owe money? It's, am I positioned to benefit from compounding? Debt isn't the enemy. Poor allocation is. And over long horizons, opportunity cost quietly outpaces emotion. In the next video, we examine another sacred rule, why saving money the traditional way in 2026 may also be quietly costing you. If you want to understand how the system works, not just follow inherited advice, subscribe to the channel.